Howdy, Jacob here. Today we're looking at next company in our dividend yield screener, Energy Transfer. So let's dig into some of the financials here. First thing, $44.7 billion market cap, $91.3 billion enterprise value, immense amount of net debt, enterprise with the enterprise value over double the market cap, currently shooting out $1.25 yield at 9.4%. It's a oil, gas, and consumable fuels industry. It looks like the company owns and operates approximately 11.6 thousand miles of natural gas transportation pipeline and 3 natural gas storage facilities in Texas. Looking at their revenue growth, looks like some wonky years in 2015, 2016, 2020. Otherwise, very, very volatile, inclusive of those, very volatile revenue growth. Return on invested capital, very low, even in the substantial earnings of the most recent 2 years. It looks like roughly 5% ROIC prior, 1 to 2% return on invested capital. So nothing to brag to home about. Let's see, they're currently paying out $4 billion in dividends, and if we look at last 5 years, we have 5.7 roughly billion, a little over 8 billion, and then 2 billion, 2 billion, 0 billion. So for me, I'm thinking to not give too much credit to current years. If we were to cut this in half to 2 billion, I might even cut it by 75% to 1 billion payout. I feel like I'd be confident in a 1 billion payout here. So let's do that. And then that would have it be roughly still 2.4%, roughly 2.3, 2.4% yield. So doesn't quite meet the criteria for 4% that we're looking for. But it still looks like that's a manageable dividend to pay out for them. And so let's start making some other assumptions here. Looks like revenue's gone up so much recently. I hate to do it again, but 0% on the revenue side, 10 on the PE, 15 discount rate for 10 for a PE and price free cash flow for a business that's not growing, and then 0 revenue growth for the next 7 years, basically saying that it might go down in the most recent years and then go up maybe by years 4, 5, 6, 7 to a similar level to where it's at now. As for margins, they've been a lot higher recently, but still might take an average here. Let's try 4, 4.5. Maybe let's assume 2% increase on the revenue side. Oops, that's why. And then to cut the dividend to a quarter. All right, so yeah, that looks more right. So this is saying that the company would need to fall 58% before a 15% return, given these assumptions. Based on the initial review of financials, I think those are fairly conservative assumptions, and as of right now, I don't see them holding the $4 billion payout for the next every year for the next 7 years. I feel more confident that they'll have to cut it quite a bit, which for this screener, we're looking for dividend yielding stocks greater than 4%. And so for me, it won't quite fit in the remnants of the screener, but still seems like a company I'd put on my general watch list. So I hope everyone has a good rest of their day, and thanks.